The recent collapse in silver prices did not begin as a dramatic event. It unfolded quietly, almost mechanically, before accelerating into what market participants would later recognize as a severe sell-off. To understand why silver is now attempting to rebound, it is first necessary to examine why the decline occurred in the manner that it did, and why it carried implications far beyond a single commodity market. At the surface level, the move appeared familiar. Prices fell rapidly, technical levels broke, and volatility expanded. Yet this interpretation is insufficient. The sell-off was not driven by a singular headline, nor by a sudden collapse in demand. It was the result of structural pressures interacting with fragile market conditions. Silver did not fall because confidence disappeared overnight. It fell because the system supporting its price was already under strain. One of the defining features of the decline was speed. Silver moved lower faster than fundamentals alone would suggest. This is often a signal that leverage, rather than discretionary decision-making, is driving price action. In modern commodity markets, futures contracts dominate price discovery. These instruments allow large exposure with limited capital, but they also introduce instability. When prices move against leveraged positions, margin requirements increase. When margin requirements rise, positions must be reduced or closed. This dynamic creates forced selling, which feeds on itself. During the sell-off, this feedback loop became visible. As key technical thresholds were breached, automated trading systems accelerated the decline. Stop-loss orders were triggered, risk models recalibrated. Liquidity thinned precisely when it was most needed. What appeared to be aggressive selling was, in many cases, mechanical liquidation. The market was not making a judgment about silver's long-term value. It was responding to short-term constraints. This distinction matters. Markets driven by forced selling do not clear at fair value. They overshoot. The absence of natural buyers during moments of stress allows prices to fall below levels justified by supply and demand. Silver's decline reflected this phenomenon. Trading volumes spiked while price stability deteriorated, indicating stress rather than orderly rebalancing. Another critical factor was the broader macroeconomic environment. Rising interest rates and tighter financial conditions had already begun to pressure all non-yielding assets. Silver, unlike bonds or cash, offers no income. In an environment where capital seeks safety and liquidity, assets perceived as volatile become vulnerable. This vulnerability is magnified when investors must sell not because they want to, but because they have to. Compounding this pressure was silver's dual identity. Silver is both an industrial input and a monetary metal. In periods of economic expansion, industrial demand supports prices. In periods of financial stress, its monetary characteristics can attract capital. During the recent sell-off, neither side provided protection. Slowing industrial expectations weakened one pillar of support, while rising real yields undermined the other. Silver found itself exposed on both fronts. Importantly, the sell-off did not reflect a collapse in physical demand. Premiums in certain physical markets remained elevated even as futures prices declined. This divergence highlighted a growing disconnect between paper pricing mechanisms and underlying material flows. While futures markets were dominated by leverage reduction and risk management, physical buyers were not exiting at the same pace. This imbalance did not stop the decline, but it underscored its artificial nature. The timing of the move further reinforces this interpretation. The sharpest declines occurred during periods of thin liquidity, when marginal selling exerts outsized influence on price. These conditions amplify volatility and distort signals. In such environments, prices reveal stress more than truth. Crucially, silver did not sell off in isolation. The move coincided with broader repricing across risk assets. Equities experienced volatility. Credit spreads widened. Currency markets showed signs of strain. Silver's decline was part of a wider adjustment to tightening financial conditions, not an isolated rejection of the metal itself. This context reframes the central question. The issue is not whether silver deserved to fall to the levels it reached. The issue is whether the sell-off resolved underlying imbalances or merely exposed them. Forced liquidation can reset positioning, but it does not repair structural fragility. It transfers risk from leveraged holders to those willing or able to absorb volatility. As silver now attempts to rebound, this distinction becomes critical. A rebound following a forced sell-off can occur quickly, but speed does not equal stability. Without understanding the mechanics of the decline, any recovery risks being misinterpreted. The sell-off was not a conclusion. It was a signal. Structural pressures. Beneath the surface, the silver sell-off cannot be understood solely through the mechanics of liquidation. Beneath the visible price action lies a network of structural pressures that had been building long before the decline began. These pressures did not cause the sell-off in isolation, but they shaped its severity and determined how fragile the market had become. Without addressing them, any rebound remains vulnerable. At the center of these pressures is global liquidity. Over the past cycle, financial markets were conditioned by abundant capital, low interest rates, and generous risk tolerance. Silver benefited from this environment, not because its fundamentals dramatically improved, but because liquidity allowed capital to flow into increasingly speculative exposures. As monetary conditions tightened, that support quietly eroded. Liquidity tightening does not announce itself with a single event. It manifests through reduced balance sheet expansion, higher funding costs, and a more selective approach to risk. For leveraged markets such as silver futures, this shift is decisive. As funding becomes more expensive, the cost of holding positions rises. Margins matter more. Volatility becomes punitive rather than opportunistic. In this environment, even neutral price movements can force position reductions. Real interest rates further intensified this pressure. As inflation-adjusted yields moved higher, the opportunity cost of holding non-yielding assets increased. This dynamic is often discussed in relation to gold, but it applies equally, if not more aggressively, to silver. Silver's higher volatility makes it less resilient when capital becomes yield-sensitive. What might be tolerated in a low-rate environment becomes untenable when returns elsewhere appear safer and more predictable. Currency strength compounded the problem. A stronger reserve currency places additional pressure on globally traded commodities priced in that currency. For silver, this effect is amplified by its participation in both industrial and financial demand channels. When global growth expectations weaken alongside tighter financial conditions, silver absorbs pressure from multiple directions simultaneously. Yet, demand-side explanations alone are insufficient. Supply-side constraints reveal a more complex picture. Silver mining is rarely primary. Much of global supply is produced as a byproduct of base metal mining. This structure limits the industry's ability to respond flexibly to price declines. Production does not rapidly shut down when prices fall, nor does it quickly expand when prices rise. This rigidity can stabilize markets over long horizons, but it also creates distortions when pricing becomes detached from production economics. During the sell-off, spot prices approached levels that challenged the sustainability of future supply. However, markets did not react with immediate concern. This is a recurring feature of financialized commodity markets. Short-term pricing is driven by capital flows rather than production realities. The consequence is delayed feedback. Stress accumulates quietly until it can no longer be ignored. Institutional positioning further aggravated the decline. Large participants, constrained by risk models and portfolio mandates, reduced exposure as volatility increased. These decisions were not judgments on silver's value, but responses to correlation, drawdown limits, and portfolio stress. When silver began to move in tandem with broader risk assets, it lost diversification appeal at precisely the wrong moment. Algorithmic trading systems magnified these effects. Such systems are designed to respond to momentum, volatility, and trend persistence. In stable conditions, they provide liquidity. In unstable conditions, they withdraw it. As silver breached successive support levels, these systems reinforced the prevailing direction. Liquidity did not disappear randomly. It was systematically removed as risk thresholds were crossed. Another underappreciated pressure emerged in market depth. During periods of calm, the silver market appears liquid. Bid-ask spreads are narrow, and large trades clear efficiently. During stress, this depth proves illusory. Orders that would normally be absorbed instead push prices disproportionately. The sell-off revealed how shallow effective liquidity had become, particularly during off-peak trading hours. This fragility is not unique to silver. It reflects a broader transformation in market structure, where apparent liquidity is often conditional. When conditions deteriorate, that liquidity vanishes. Silver's sell-off exposed this reality with unusual clarity. Meanwhile, physical market indicators told a different story. Inventory movements and delivery patterns suggested continued demand, even as futures prices declined. This divergence highlighted a structural disconnect between financial pricing mechanisms and real-world usage. While paper markets repriced rapidly, physical flows adjusted slowly. The two systems were not synchronized. This disconnect is not inherently destabilizing, but it becomes dangerous when interpreted incorrectly. Futures markets set reference prices, influencing sentiment and investment decisions. When those prices reflect financial stress rather than physical balance, they transmit misleading signals. Taken together, these structural pressures explain why the sell-off was so abrupt and why it may not have resolved underlying vulnerabilities. Liquidity constraints, yield sensitivity, rigid supply structures, institutional risk controls, and conditional liquidity all contributed to an environment where silver could fall faster than fundamentals justified. The attempted rebound must be evaluated against this backdrop. Structural pressures do not disappear when prices stabilize temporarily. They recede only when conditions change. Without such change, any recovery remains provisional. The sell-off revealed fragility. The rebound will test whether that fragility has been addressed or merely paused. Have you ever jumped into a new relationship right after a breakup? Or maybe you're dating someone who just got out of a long-term thing. Welcome to the world of the rebound relationship. It's a term we hear all the time, but what does it actually mean? Is it a genuine new beginning or just a temporary fix for a broken heart? Today, we're diving deep into the psychology of the rebound to figure out if it's a real signal of moving on or just an illusion. Let's get one thing straight. Breaking up is tough. It can leave a huge void in your life. Suddenly, the person you shared everything with is gone. This emotional vacuum is incredibly uncomfortable, and our natural instinct is to fill it as quickly as possible. That's where the rebound comes in. It offers an immediate distraction from the pain, a source of validation, and a way to feel connected again. It feels good, right? Someone finds you attractive, you're going on dates, you're not sitting at home alone. It's a powerful, comforting feeling. So, how can you tell if you're in a rebound relationship, either as the rebounder or the reboundee? There are a few classic signs. One of the biggest is speed. If the relationship goes from 0 to 100 in a flash, that's a potential red flag. Think about it. Are you truly building a new connection, or are you just trying to replicate the intimacy you just lost? Another sign is constant comparison. If you or your new partner are always talking about the ex, whether it's good or bad, it shows that the old relationship is still taking up a lot of mental real estate. They haven't fully closed that chapter. Another key indicator is the emotional foundation, or lack thereof. A rebound often feels more like a fun distraction than a deep, meaningful connection. You might have a great time together, but when it comes to talking about real feelings, future plans, or vulnerabilities, the conversation falls flat. It is almost like you're playing the part of a couple without doing the real emotional work. You're using the new person as a stand-in, a temporary patch to cover the wound left by the breakup. This isn't fair to you, and it's definitely not fair to the other person who might be developing genuine feelings. Now, here's the big question. Are all rebound relationships doomed? Not necessarily. Some people genuinely meet their perfect match while on the rebound. The key difference is self-awareness. If someone has taken the time to process their breakup, understand what went wrong, and truly feel ready to move forward, a new relationship can be healthy, even if it starts soon after the last one. But if you're using someone to avoid your feelings, it's an illusion. It's a temporary painkiller that prevents you from actually healing. True healing comes from within, not from another person. So what's the takeaway here? If you've just gone through a breakup, give yourself time. It's okay to be single. It's okay to feel sad. Use this time to rediscover yourself, your passions, and what you truly want in a partner. And if you suspect you're someone else's rebound, be cautious. Protect your heart. A healthy relationship is built on two whole individuals coming together, not two broken halves trying to make a whole. The rebound can feel like a signal that you're moving on, but more often than not, it's an illusion that keeps you stuck. Take the time you need to heal properly. You deserve a love that's real, not just a reaction. Have you ever wondered about the story behind silver? It's not just a shiny metal for jewelry or silverware. For centuries, it's been a cornerstone of the global financial system, a safe haven in turbulent times and a critical industrial component. Today, we're diving deep into the world of silver, exploring its unique market behavior and what it means for your investment strategy. Let's start with a bit of history. Silver, alongside gold, is one of the oldest forms of money. Ancient civilizations, from the Greeks to the Romans, used silver coins as their primary medium of exchange. This historical role as real money is crucial. It's etched into our collective financial DNA, which is why, even today, investors flock to silver during times of economic uncertainty. Think of it as a financial anchor. When currencies fluctuate and stock markets get choppy, silver's tangible value provides a sense of stability that paper assets just can't match. This isn't just nostalgia, it's a time-tested strategy for wealth preservation. Now, let's talk about silver's dual personality, which is what makes it so fascinating. On one hand, it's a precious metal, a monetary asset. On the other, it's a vital industrial commodity. Silver is the most conductive and reflective metal on the planet. This means it's irreplaceable in a huge range of modern technologies. It's in your smartphone, your laptop, the solar panels on your roof, and even in electric vehicles. This industrial demand creates a solid floor for silver's price. Unlike gold, which is primarily held for investment or adornment, more than half of all silver mined each year is consumed by industry. This means, as technology advances and the green energy transition accelerates, the demand for silver is set to grow significantly. So, how does this dual nature affect its price? This is where things get interesting. Silver's price is a constant tug of war between investment demand and industrial demand. When investors are worried about inflation or geopolitical risk, they buy silver, pushing the price up. Simultaneously, when global manufacturing is booming, industrial consumption increases, also supporting the price. However, this also makes silver notoriously volatile. It's often called gold on steroids. Its market is smaller than gold's, so the same amount of money moving in or out can cause much larger price swings. This volatility can be a double-edged sword. It offers the potential for significant gains, but it also comes with higher risk. This brings us to the gold to silver ratio. This is a simple yet powerful tool for investors. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged around 40 to 50. When the ratio is high, say 80 or 90 to 1, it suggests that silver is undervalued compared to gold. Many strategic investors see this as a buying opportunity for silver, anticipating that the ratio will eventually revert to its historical mean. Conversely, when the ratio is low, it might suggest that silver is overvalued relative to gold. Keeping an eye on this ratio can provide valuable clues about market sentiment and potential turning points. So, how do you incorporate silver into your own financial strategy? It really depends on your goals and risk tolerance. Let's break it down for different types of investors. For the conservative, long-term investor focused on wealth preservation, think of silver as a form of financial insurance. Holding a small percentage of your portfolio, maybe 3 to 5%, in physical silver like coins or bars, can act as a hedge. It can protect your purchasing power against inflation and provide stability during a stock market downturn. For this investor, the goal isn't to get rich quick, but to ensure that a portion of their wealth is secure outside the traditional banking and financial system. You're not trying to time the market, you're just holding a real, tangible asset for the long haul. Now, for the more growth-oriented or speculative investor, silver's volatility presents an opportunity. You might consider using silver to seek higher returns. Instead of just physical metal, you could look at silver mining stocks or exchange-traded funds known as ETFs. Mining stocks can offer leveraged exposure to the silver price. If the price of silver goes up by 10%, a well-run mining company's stock could potentially go up by 20 or 30% as their profit margins expand dramatically. However, the reverse is also true. Mining stocks carry additional risks related to operations, management, and political factors in the countries where they operate. ETFs, on the other hand, offer a convenient way to invest in silver without having to store physical bars. They trade just like a stock, making them liquid and easy to manage. Let's discuss risk management. Given silver's volatility, it's crucial to allocate your capital wisely. A common mistake is going all in when you feel bullish. A more prudent approach is dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of the price. This strategy smooths out your purchase price over time and reduces the risk of buying everything at a market top. It's also vital to remember that silver should be part of a diversified portfolio, not the entire portfolio. It works best when combined with other assets like stocks, bonds, and real estate. Its unique price drivers mean it often moves independently of these other assets, which is the very definition of diversification. The broader implications for the financial system are also profound. A significant, sustained rise in the price of silver is often a signal of distress in the wider economy. It can indicate a loss of confidence in fiat currencies and government policies. Central banks and policymakers watch the precious metals markets closely, as they can be the canary in the coal mine, warning of underlying economic problems like runaway inflation or systemic risk. The push towards green energy also has massive implications. As governments worldwide mandate a shift to renewables and electric vehicles, the structural demand for industrial silver is likely to create a long-term tailwind for the price, independent of investment flows. In summary, silver is far more than just a poor man's gold. It is a unique and complex asset with a rich history and a vital future. Its dual role as both a monetary metal and an essential industrial commodity creates a dynamic and often volatile market. For investors, it offers a powerful tool for both wealth preservation and growth, but it must be handled with a clear understanding of its risks. By paying attention to the gold to silver ratio, diversifying your holdings, and choosing an approach that matches your risk tolerance, you can strategically use silver to strengthen your financial position. Whether you're safeguarding your wealth or seeking out new growth opportunities, silver deserves a place in the conversation. Thank you for watching. Please subscribe to our channel for more insights.